Hello, my name is Jun Kaisha, and today I'll be presenting my entertainment accounting analysis for Film 500, Session 4 with Professor Sahin. For this assignment, I chose La La Land, the 2016 award-winning musical film, as my case study. La La Land is a compelling example because it generated revenue from multiple sources: box office, ticket sales, streaming, license deals, and original soundtrack royalties, all of which involve different accounting treatments under GAAP. Okay, here we go. So, La La Land was directed by Damien Chazelle and produced by Summit Entertainment with a production budget of just $30 million. Despite its modest budget, the film grossed over 446 million worldwide. That's a 14.9 times return on investment, which is exceptional by Hollywood standards. Okay, the movie operated through multiple revenue streams: theoretical box office, home video, streaming license, and the sales of original soundtrack. It also won 6 Academy Awards in 2017, which is important from an accounting perspective because those wins trigger performance bonus clauses in the talent contracts, creating 3.2 million in new liabilities. On the right, you can see the key figures will be working on with a 30 million production budget, 446 million in box office revenue, 8.5 million from the soundtrack, and 3.2 million in awards bonuses. You can see the awards bonuses a lot, right? Okay, so let's just see the first transaction. On the first transaction is the recognition of box office revenue, and this is where the ASAC 606, the revenue recognition standard, comes into play. When La La Land screening theaters submitted entertainment's performance obligation under ASC 606 was to provide the customer, meaning the audience, with access to view the film. The obligation is satisfied by the point of exhibition, not when the distribution contract with the theater chain was signed. So, in journal entry A, when the distributor remits box office receipt, we debit cash for 446 million and credit theoretical revenue for 446 million. Both are recorded at the moment the customer watches the film. In journal entry B, we record the distribution cost, among approximately 50% of the revenue as a debt to distribution expenses as a credit to cash. This reduces equity through net income. Look at the accounting equation on the right. Cash goes up, revenue goes up, and equity increases via net income. The equation stays balanced. Okay, let's go to the second transaction, streaming licensing revenue. Our record transaction involve a streaming license deal, especially submitted entertainment licensing La La Land, a streaming platform for 45 million over a 3-year window. This is a great example shows why GAAP matters under ASAC 606 when the license grants ongoing access to intellectual property, like a 3-year content license. Revenue must be recognized over time, not at all at once. The standard requires straight line recognition over the 36 months access period. In journal entry A, when Submit receives the 45 million upfront, we can debt cost for 45 million and credit deferred revenue, a liability for 45 million. Notice, cash coming, but no revenue is earned yet. Then in journal entry B, each month we debt deferred revenue for 1,2500 K, which is 45 million divided by 36 months, and credit licensing revenue. This repeats every month for 3 years. On the accounting equation side, cash goes up, deferred revenue goes up as a liability, so both sides increase equally. There's no equity embedded at the time of receipt. Equity only increases each month as the license is provided. Okay, let's go to the third transaction, Soundtrack loyalties and rewards bonus. Our third transaction involves two related events happening simultaneously: the recognition of Soundtrack loyalty income and the recording of rewards trigger bonus liability. The La La Land soundtrack generated around 8.5 million in royalty revenue for Submitted. At the same time, winning 6 Oscars in February 2017 triggered performance bonus clauses in Ryan Gosling and Emma Stone's contracts, totaling 3.2 million. On the matching principle, both of these should be recorded in the same period they occur, which is the night of Academy Awards. In Journal Entry A, we record the loyalty income debit cash for 8.5 million, credit loyalty revenue for 8.5 million. In Journal Entry B, we recorded the bonus application debit bonus expense for 3.2 million and credit bonus payable liability to 3.2 million. We don't wait until the bonus is actually paid to the record this. Net effect on equity. Revenue increases by 8.5 million. Expense decreases by 3.2 million. So net equity increases by 5.3 million. The equation balances. Okay, so the takeaway from financial accuracy analysis. Starting with the top left box office revenue timing is generally handled correctly. Hollywood studios do apply point-in-time recognition for theoretical theater revenue consistent with XX 603. However, top right is a common error. Some entertainment companies record multi-year streaming licensing deals as immediate revenue when the cash is received. That's cash-based thinking. It violates GAAP. The correct treatment, as we demonstrated, is deferral and straight-line recognition over the license period. Bottom left is the oversight awards bonus are sometimes expensed only when paid, rather than accrued on the obligation date. GAAP requires the accrual to happen in the same period the performance application is triggered, the night of award ceremony. Finally, the bottom right is correct. Record COGS or loyalty simultaneously with related revenue properties. Applies the matching principle, ensuring gross profit is not distorted. Okay. To summarize, the analysis of La La Land illustrate 4 core accounting principles in action. First, revenue recognition on the ASX 606. Earning cash is not the same as earning revenue. So, theater revenue is recognized when the customer watches the film, and streaming license must be deferred and recognized over time. Second, the matching principle expense, like awards, bonuses, and distribution costs, must be recorded in the same period as the revenue they related to ensure net income is accurately stated. Third, accurate accounting. GAAP requires recording all revenues and expense when they are incurred or earned, not when cash changes hands. Fourth, IP licensing complexity. Multi-year content licensing requires very careful evaluation to determine whether recognition is point in time or over time, and getting that wrong materially mistake a company's financials. So, to be in short, La La Land may be a short story about love and jazz, but from a content's perspective, it's a masterclass in revenue recognition. Okay, here's a reference page. Okay, thank you. Thanks, everybody.